How can you understand complex finance, economic indicators easily? Imagine trying to navigate a foreign city without a map or guide. The streets are unfamiliar, and the signs are in a language you do not understand. Now, think of economic indicators as the signs and landmarks that help you find your way through the financial landscape. To truly grasp these indicators, it is essential to decode what they reveal about the economy's health and future trends. Begin by familiarizing yourself with the most common indicators. Gross domestic product is a key measure of the total value of goods and services produced within a country over a specific period. It reflects the overall economic activity and growth rate. When the gross domestic product increases, it generally indicates economic expansion. A decline suggests contraction. Consumer Price Index measures the average change over time in prices paid by consumers for a market basket of goods and services. It is a primary gauge of inflation. A rising consumer price index signals increasing inflation, which can erode purchasing power, while a stable or falling index indicates price stability. Unemployment rate shows the percentage of the labor force that is unemployed and actively seeking work. High unemployment can signal economic distress, whereas very low unemployment might lead to inflationary pressures. The Purchasing Managers Index surveys manufacturing and service sectors to assess business conditions. Readings above 50 suggest expansion, while below 50 indicate contraction. These indicators are often released monthly and can be used to anticipate economic trends. To interpret these indicators effectively, pay attention to their historical patterns and how they interact. For example, a rising gross domestic product coupled with a low unemployment rate typically signals a healthy economy. Conversely, if inflation is rising rapidly alongside increasing gross domestic product, it might suggest overheating, prompting policymakers to consider measures to cool down the economy. It is also crucial to understand the context in which these indicators are released. External factors such as geopolitical events, changes in commodity prices, or monetary policy decisions can influence their significance. For instance, a sudden spike in inflation might be linked to rising oil prices or supply chain disruptions. Utilize visual tools such as charts and graphs to observe trends over time. Comparing current data with historical averages can help identify whether indicators are signaling positive growth or potential warning signs. Reading expert analyses and reports can provide additional insights into what the numbers imply for the broader economy. In summary, understanding complex economic indicators becomes easier when you learn what each measure represents, observe their historical and current trends, and consider the broader economic context. With practice, these indicators will become familiar landmarks guiding you through the intricate terrain of financial analysis.